The retirement stock market dilemma. Are you worried about the stock market in 2025 and how it might affect your retirement savings? You're not alone. Many retirees are asking themselves the same question. Should I stay invested, or is it time to pull out and play it safe? The truth is, completely stepping away from the market could cost you in the long run, but staying in without a strategy could feel like a gamble. So, how do you protect your nest egg without missing out on potential growth? In this video, we'll explore smart ways to stay invested while minimizing your risk. We'll look at balancing income and growth, how dividend-paying stocks can be your best friend, and strategies for managing your withdrawals so your money lasts. If you're unsure about how to approach the market in 2025, stick around. We're going to show you that it's not about choosing between safety and growth. You can have both. Let's dive into why staying invested is still important in retirement and how to do it wisely. The importance of staying invested in retirement. As retirees face the uncertainties of 2025, the urge to pull out of the stock market entirely can be strong. After all, safeguarding your nest egg feels like the safest option. However, stepping away from investments entirely could do more harm than good. Inflation is a silent threat to your purchasing power, slowly eroding the value of your savings. With rising costs for healthcare, food, and housing, relying on fixed income assets alone might not be enough to sustain the lifestyle you've worked so hard to maintain. That's why staying invested, at least to some degree, remains essential. The stock market offers opportunities for growth that can help your savings keep pace with inflation. By carefully selecting dividend-paying stocks or funds, for example, retirees can enjoy regular income while also benefiting from potential appreciation over time. This approach offers a way to hedge against inflation without taking on unnecessary risk. Strategic asset allocation is key here. Rather than going all in or pulling out completely, diversifying across a blend of stocks, bonds, and cash allows you to spread out the risk while still maintaining some growth potential. It's all about balance. By staying invested, you position yourself to better handle the rising costs of retirement, ensuring your money lasts as long as you need it. This is particularly important for longevity planning. Retirees today can easily live for 20 to 30 years after leaving the workforce, and investments that grow over time can help preserve your financial security. With these considerations in mind, it's important to understand what lies ahead in 2025. Market predictions for 2025, what you should know. Looking ahead to 2025, the stock market brings both risks and opportunities, which can feel daunting for retirees trying to protect their hard-earned savings. Economic uncertainties, such as inflation, interest rate hikes, and potential geopolitical events, are real concerns that could impact market performance. For many older adults, the fear of a market downturn is enough to make them want to retreat to safer, fixed-income investments. But staying out of the market entirely could mean missing out on valuable growth opportunities. Despite the risks, there are sectors poised for significant gains. The technology sector, for example, continues to drive innovation, particularly in areas like artificial intelligence, cybersecurity, and clean energy. These advancements are expected to grow rapidly in the coming years, making technology a promising area for those willing to take on some level of risk. Healthcare is another sector to watch, especially as aging populations worldwide increase demand for medical services, pharmaceuticals, and biotech innovations. These industries are likely to remain strong, providing both stability and growth potential for investors. For retirees, these market predictions matter because they directly impact your financial strategy. If you're too conservative and pull all your investments into low-risk assets, you could lose the potential for gains that outpace inflation, leading to a slow erosion of your wealth. But if you're too aggressive, you might expose yourself to unnecessary risk, which can be dangerous when you're no longer in the workforce to make up for losses. The key is finding a balance between risk and reward that aligns with your retirement goals. This is where understanding market opportunities becomes crucial. By diversifying your portfolio to include sectors with growth potential, like technology and healthcare, you can create a strategy that balances the need for both income and growth. For instance, even if the broader market faces volatility, these industries may offer more resilience, helping to cushion your portfolio against larger losses. As you approach or settle into retirement, shifting your focus from pure growth to income becomes more important. Transitioning from growth to income strategies. As retirees approach 2025, transitioning from a growth-focused portfolio to one that prioritizes income is a natural step. However, this shift doesn't mean abandoning stocks entirely. Instead, it's about gradually reducing risk exposure while still allowing for some growth to keep pace with inflation. The key is finding a balance that provides both income and security. One effective way to achieve this is by incorporating more dividend-paying stocks into your portfolio. These stocks offer regular income payouts, which can supplement your retirement savings while still allowing for some market appreciation. Companies that pay consistent dividends are often stable, well-established firms, which can help reduce the overall volatility of your portfolio. These stocks act as a bridge between growth and income, offering the best of both worlds. Alongside dividend-paying stocks, adding bonds and other fixed-income investments can further stabilize your portfolio. Bonds provide regular interest payments and tend to be less volatile than stocks. In particular, government bonds and high-quality corporate bonds are good options for retirees looking to protect their principal while receiving steady income. It's essential to gradually increase your allocation to these safer investments as you get older, but it's equally important not to pull out of stocks completely. Maintaining some stock exposure ensures that your portfolio can still grow, even as you prioritize income. A practical approach might involve creating a well-diversified mix of dividend-paying stocks, bonds, and other income-generating assets, like real estate investment trusts, REITs. This type of balanced portfolio can meet your income needs while also offering the potential for modest growth. Adjusting your allocation over time, rather than all at once, allows for a smoother transition and reduces the risk of timing the market incorrectly. By carefully managing this shift, you can ensure your portfolio continues to support your retirement goals. And when it comes to income generation, dividend-paying stocks play an important role. Dividend-paying stocks, a reliable source of retirement income. Dividend-paying stocks can be a game changer for retirees looking to balance income and growth in 2025. These stocks provide a reliable income stream through regular dividend payments, which is especially important for retirees who need consistent cash flow without exposing themselves to excessive risk. Unlike bonds or other fixed-income investments, dividend stocks offer the potential for growth in addition to income, giving your portfolio a bit of extra flexibility. The appeal of dividend-paying stocks lies in their stability. Companies that consistently pay dividends tend to be well-established and financially sound. Industries like utilities, consumer goods, and healthcare are often known for offering stable dividends, as these sectors provide essential services that people rely on regardless of the economic climate. Companies like Johnson & Johnson or Procter & Gamble are classic examples of firms that have a long history of paying dividends, making them solid choices for retirees looking for both income and safety. The key benefit here is that dividends not only provide you with regular income, but also offer the possibility for growth if the stock appreciates in value. This dual advantage can help protect against inflation, ensuring that your purchasing power remains intact over time. As part of a broader retirement strategy, dividend-paying stocks can complement safer assets like bonds, offering a balanced approach that still leaves room for growth. Managing risk in your stock portfolio. Managing risk while staying invested in stocks is crucial for retirees, especially in 2025, when market uncertainties can feel overwhelming. One of the most effective strategies for minimizing risk is diversification. By spreading your investments across different sectors, asset classes, and even international markets, you can reduce the impact of any single downturn. For example, while one sector like technology may experience volatility, another like healthcare or utilities might remain stable, helping balance your portfolio's overall performance. Diversification isn't limited to just sectors, though. It's also smart to invest in a mix of asset classes. Stocks offer growth potential, but combining them with bonds or other fixed income investments adds a layer of security. Some retirees may even consider diversifying into international stocks to capture growth opportunities in other markets, further reducing their exposure to domestic market risks. By maintaining this variety in your investments, you ensure that your portfolio is better insulated from market shocks. Regularly reviewing and rebalancing your portfolio is equally important. As market conditions change, your asset allocation can drift from your original plan, potentially increasing your exposure to risk. Setting aside time, perhaps once or twice a year, to review your investments and make necessary adjustments helps keep your portfolio aligned with your goals. Rebalancing might involve selling off assets that have grown too large a portion of your portfolio and reinvesting in areas that need more balance. This proactive approach helps you stay on track and prevents unnecessary risks from creeping into your strategy. The key is not to overreact to short-term market fluctuations. Staying calm and making gradual adjustments ensures that you protect your nest egg without making drastic changes that could hurt your long-term financial security. As you manage risk, it's also important to consider how much you can safely withdraw from your portfolio to support your retirement lifestyle. Safe withdrawal rates, protecting your nest egg. The concept of a safe withdrawal rate is key for retirees who want to enjoy their retirement without worrying about outliving their savings. The traditional 4% rule has long been the go-to guideline, suggesting that retirees can safely withdraw 4% of their retirement portfolio each year without running out of money. But with today's volatile market and the uncertainties 2025 may bring, many experts are rethinking whether this rule still holds up. In a low-interest environment, combined with market fluctuations and inflation concerns, the 4% rule might be too aggressive for some. Instead, more flexible withdrawal strategies can offer a better solution. One approach is to adjust your withdrawals based on market performance. For instance, if your portfolio grows significantly in a good year, you might withdraw a little more. But in years when the market takes a hit, scaling back your withdrawals can help preserve your nest egg. This strategy requires a bit more attention, but can make a significant difference in ensuring your money lasts. Another option is to use a dynamic withdrawal rate that takes into account your actual spending needs, rather than sticking to a fixed percentage. Some retirees might prefer to start with a lower withdrawal rate, say 3%, and increase it over time as needed. This can be a more conservative approach, especially during periods of high market volatility. Ultimately, the goal is to avoid depleting your savings too quickly. A well-diversified portfolio, combined with a cautious withdrawal plan, can help keep your finances stable throughout your retirement years. By adjusting your strategy to the realities of today's market, you can feel more confident that your nest egg will last. Of course, making these decisions alone can be overwhelming, which is why seeking professional financial advice can be crucial. The role of professional financial advice in 2025. Navigating the stock market in 2025 can feel complex, especially for retirees who are focused on preserving their savings while still allowing for growth. This is where professional financial advice becomes invaluable. A skilled financial advisor can help optimize your portfolio by balancing risk and return, ensuring that your investments are aligned with your long-term goals. They can guide you in selecting the right mix of assets, from dividend-paying stocks to bonds, while also providing personalized advice based on your unique situation. One of the greatest benefits of working with a financial advisor is having someone to regularly review your financial plan. Markets change, and so do your needs as you move through retirement. By checking in with a professional periodically, you can make adjustments to your asset allocation and withdrawal strategy, ensuring that you stay on track even in uncertain times. An advisor can also help you navigate more complex decisions, such as when to rebalance your portfolio or how to take advantage of market opportunities without exposing yourself to unnecessary risk. In a volatile market, this kind of informed guidance can make all the difference in protecting your nest egg. With professional support, you can feel more confident about your financial future. Now that we've covered how to manage risk and plan for withdrawals, let's sum up the key takeaways for retirees in 2025. Should you stay invested? Key takeaways for older adults. In 2025, retirees face the challenge of balancing growth and income while minimizing risk. Staying invested in the stock market, even partially, is essential to ensure your savings continue to grow and keep up with inflation. Dividend-paying stocks offer a reliable income stream while still providing the potential for growth, making them a key component of a well-rounded portfolio. Diversifying across different sectors and asset classes can help protect against market volatility, and regular rebalancing ensures that your investments remain aligned with your goals. Managing withdrawals carefully is also critical. Whether using a flexible approach or adjusting based on market conditions, the goal is to avoid depleting your savings too quickly. Seeking professional financial advice is one of the smartest moves you can make, helping you navigate uncertainties with expert guidance and optimize your strategy for long-term success. The main takeaway? Stay proactive, adaptable, and informed. With the right balance between risk and reward, you can continue to enjoy a financially secure retirement in 2025 and beyond. Now that we've covered these strategies, let's wrap up with some final thoughts. Conclusion: navigating the 2025 market with confidence. As you move through 2025, staying invested in the stock market with a thoughtful, balanced approach is key to maintaining financial security. By staying informed, adapting to changes, and making smart decisions, you can protect your nest egg while still allowing for growth. Be confident in your strategy and remember that a proactive approach will serve you well in the long run. If you found these insights helpful, stay connected to our channel for more tips on securing your financial future. Thank you for watching this video and stay blessed.